For today's video, we have 1 hour model tests that you would find in typical infrastructure investment banks. So what we're going to be modeling is a simple case study for an LNG facility. And we're going to read through the case study. But before we do that, we're actually going to put myself on the clock here. For full transparency, I'm going to use the Excel formula for time. And we're going to actually see how long this case study takes me. So it's 1:10 p.m. We haven't started reading through anything yet. And that's essentially going to be your first step when you're doing these modeling tests. Read through the entire instructions and start to jot through some key details of what you're going to be working on. So your first step in these model tests is 1, take a breath, try to be as calm as possible. We all make mistakes when we're rushing. And 2 is go and read through all the materials provided and comb through the Excel to make sure you're aware of all the information you have on hand. So we're going to just quickly read through this. Some sort of Smith Energy Partners. You got a 1.25 per annum MTPA liquefaction facility. We have a construction period. So right away, I'm going to start figuring out my flag. So construction period, we're going to insert 2 columns as I typically do. Make everything 10. And before we do everything, I'm actually just going to make my font size 8. Just to make sure we're not messing around with column and row sizes and all that kind of stuff. A 4-year construction period starting 24 and ending 28. So we're just going to simply make a quick flag before we even get into it. And we're just going to say this is less than our operation period here. And I'm also just going to collapse all my columns so I can pull across formulas really quickly. I'm going to put some brackets around here. Right away, we have a 4-year construction period. Continuing down, I have a 20-year SPA period. We have no mismatching on capacity versus offtake, fixed payment. So I'm going to highlight all the little CPI adjustments to start, just to make sure we don't miss anything. Commodity payment times Henry Hub. So we're given MMBTU, so we're going to have some conversion exercise here. Fixed transport charge at 20 cents, an O&M payment. And here's the ask. We have a 145 DSCR. 6% per annum, 20-year term loan. And we have a grace period on amortization payments for an interest-only period until 2030. And revenue start on 28, so at the end of our construction period. And our key asks are, what is the maximum amount of debt the project can support? And what's the resulting IRR? And 1 hour, 1:14. And we're just going to comb through the Excel quick. We have our capacity, CapEx, DSCR, interest rate, Henry Hub, and CPI. So we're going to start by pulling in our macro factors here to get everything on one page, make our formulas way easier, and a simple sum if formula, pick up our macro. Alt HK to make our formulas a little cleaner, but I would not emphasize formatting in these exercises. And we're just going to divide our CPI index by 100 to make our lives a little easier. So our SPA production is going to be just linked here. And this is going to be our first flag, but we already set this up. So we're just going to link our 2028, but then we're going to add 20 years for our term, make a simple add formula. Our year is greater than or equal to our start and less than our end period. The quick check here is that you start in 28 and you go for 20 years. And you can see our sum down here is 20 years. So we're humming along. Our SPA in MTPA, but we need to convert it to MMBTU. So we're just going to go 52 times 10 to the 6. And we have our SPA production. And then we're just going to times, so our conversion factor times our MTPA times our SPA production. And now we have our SPA production. Then we're going to do our fixed payment build up. So fixed portion, variable portion, total. And don't bother with spelling or anything like that. $2.50. And all we're going to do is times our SPA production times our fixed. So that's our fixed portion. And we're going to drag this down, same formula, but we're going to times it by our CPI adjustment factor. So that goes up, put a total line. And then our fixed payment is simply just going to be our total fixed payment build times our SPA production. That's a good portion of our revenue. revenue. And then we have the commodity payment. So 110% put in our variable, and we're going to times this times our SPA production times our Henry Hub price. And that will be our total revenue. We're about 10 minutes into the case. You never know how these things are going to go. Sometimes you make an error, and much more difficult and stressful. So gas expenses is just going to be our gas supply agreement, 20 years, our SPA production times this factor, 101% times Henry Hub. So that's our gas expense. For gas transport, it's 20 cents. And here's our CPI adjustment factor we didn't catch earlier. Very important. So gas transport it's 20 cents times our SPA production is all our transport's going to be. Simple. And then our O&M is going to be 50 million per year. So I go 50 times 10 to the 6. And that's simply going to be times our SPA production, times our flag, times our CPI index. Sorry, no SPA production multiplication here. And we're just going to quickly make everything negative. And now our CapEx, we're going to bring in here. So we're going to bring in our previous sum if and simply change the row. This is going to be row 8. So that's our CapEx. And now we're going to start to build to our free cash flow. So our free cash flow is simply our revenues plus our expenses, bunch of free cash flow there. Then we're going to go drop down to our constrained cash flows. So we're going to bring in our DSCR, and it's simply our free cash flows divided by our DSCR. And what we want to do before we get into that is get into our sizing period. Our sizing period is going to be 2030 to the 2048. So we're going to steal this formula here, fix these references, and 2030 is our first period there. Then we're just going to grab our initial sizing period, simple and formula, this equals 0, this 1, and that should show up one time. And our constrained cash flows going to equal free cash flows divided by our DSCR times our sizing period. And we want that so we're accounting for our interest only period. Then we're going to build our discount factor, which is going to be equals if our initial sizing period equals 1, then 1, otherwise the prior period divided by 1 plus our interest rate. Interest rate, 6%, pull that over. And now the period right before our constrained cash flow start is our discount factor. Then we're going to get to our debt size. And now we have a debt size. Our drawdown is going to be very first period. So we're going to make a simple corkscrew here, pull in our debt quantum, and we need a financial close flag, going to be 2024. So now our drawdown is going to be our debt quantum that we linked times our financial close, and then our amortization is going to equal negative max min. Our min is going to be the min of our debt balance on hand and our constrained cash flows less our interest expense. Pull this over, and once we add in our interest expense, we'll see if we model the debt properly. So our interest is going to be our opening balance plus drawdown times our interest rate. The last thing our amortization needs, and once we bring over our interest expense, we see that our debt fully amortizes within the last period of the contracted cash flows, and our first amortization period is 2030. So we can be decently confident we modeled the debt correctly. Now we need to go fund the project, and that's where our equity contribution comes in. So we need cash needs during construction, and that's going to be CapEx and interest. And interest is only going to be during our construction period, as it will be paid with cash flows first. But then we're going to total this. A initial period drawdown, we're going to have a cash account. So you insert, we're going to grab most of this formula here just to get the corkscrew, call this contribution drawdown. Our contribution is simply going to be our debt issuance. And then our drawdown, we're going to simply pull our cash needs. And then our equity contribution is going to be our cash needs plus our drawdown. And that's our equity contribution is this 242 million. And we're going to make that negative. We're going to go have our debt service line. So debt service during operations is going to equal amortization plus our interest expense. We're going to times that by our operation flag. Go in and distinguish our cash flow to equity. Take our SPA production flag for now. So our cash flow to equity, our free cash flow plus our debt service plus our equity contribution. And all of a sudden we have our cash flow to equity. And we're just going to do a simple formula If this equals 0, then negative 0.001. Otherwise, do this form. And that's just going to enable our IRR formula. If you don't have a negative in your initial period, IRR doesn't work. And our levered IRR, and then we're just going to IRR formula. We're in an annual period, so we don't need to use XIRR, and we get 16.89%, which is reasonable for a levered IRR. So then we're going to simply grab our two questions, A, max debt, IRR sponsor, and simply link these two. So max debt is the 865 million. Our levered IRR is 16.89. And there you have your solution for our little case study. Now, a couple things to keep in mind, and this took me a little over half an hour, given 60 minutes. So I would just go back through each of these assumptions, making sure ticked and tied all your assumptions and things flow through. Maybe you can spend some time on formatting and stuff like that. But the reality is of model tests is you're probably going to stumble a little bit, and you won't have a ton of excess time. But just for the sake of the video, I'm going to show you my final time here. So it took me a little over 30 minutes. So I hope you enjoyed the video today. This is how I would walk through a simple case study like this. And please like and subscribe. I'd love to hear your thoughts, and please provide your comments below. And I look forward to seeing you in the next video.